Good afternoon. So now that we have looked at both accounting standard number 16, property, plant and equipment, and accounting standard number 40, investment property, we can now look at a question that combine both accounting standards so that we appreciate or now to be able to tackle an exam question. My name is Winfred Sirumbwe Mpakasi, your lecturer for this session. Let me now share the practical exam question that encounters both IAS 16 and IAS 40. Great. So this is a question from SCCA, past question paper June 2017. It was carrying 8 marks. So the question is, Epsilon prepares financial statement to 31st March each year. The following events have occurred which are relevant to the year ended 31st March 2017. On 1st April 2016, Epsilon purchased a new head office property for 60 million US dollar. On the same day, Epsilon leased out the top 3 floor of the property to a third party on a long-term operating lease. Mark the word operating lease. The annual rental receivable by Epsilon was 2 million starting on 31st March 2017. The top 3 floors of the property were capable of being sold in separate transaction. Mark that it was being sold in separate transaction. On April 2016, the director of Epsilon estimated that the initial cost of the property would be allocated as follows for accounting purpose. The top floor building is 15 million US dollars, remainder 20 million US dollars, the other land 25 million US dollars, total 60 million. On 31st March 2017, the property had an expected total fair value of 64 million. The directors considered that 25% of this fair value was attributable to the top 3 floors of the property. The director of Epsilon wished to use the cost model for measuring property, plant and equipment and the fair value model for measuring investment property. Epsilon depreciates the building component of the property over an estimated useful life of 50 years with no estimated residue value. The rental payable on Epsilon 31st March was paid in accordance with the terms. So this question is encompassing both IAS 16 and IAS 40. So let's begin. So solution, number 1, first we'll gather the critical data. So one of the data is year end. Year end is 31st March. 31st March 2017. Okay? Purchase date is 1st April 2016. List date is the same, 1st April 2016. Correct. The other key information is that the property total property value is 60 million. And then the other item is that this value, this property, the fair value increased to 64 million, of which 25% is for top floor. Great. The other thing is that it was leased on operating lease. When we talk about operating risk, it means the owner has right, and this asset should be in the statement of financial position. In the statement of financial, what we mean, if it is, operating risk is whereby there is a still gain the rights and that asset will not be sold at the end of the tenure, meaning it will still continue to appear in the statement of financial position of the owner. The other thing is that it is capable of being sold separately. This means it qualifies to be mixed use. And both IAS 16 and IAS 40 applicable. The rental is 2 million. That is it. If you gather such information, it will be very useful for you to begin to tackle the question. So now, in practice now, let's prepare now I want this to go on top. Let us now solution. Sorry, let us now prepare the balance sheet. What are we talking about? Okay, good. So now, to prepare now the statement of financial position, great. We have land, and to have the value here. We also have building. We also have top floor. Now let's talk about the workings now. Great. So the workings will be as simple as we can. First of all, we are told this building, the top floor. First, let's start with top floor. Working number 1. Top floor. So top floor, the initial cost is 15 million. Let's just do this 15 million. And then the whole total building, it appreciated, or it was the fair value now came from 60 million to 64. Fair value now. Fair value, it is 64 million. And by 25%, because they're saying we need to look at what portion relates to this, because they're saying on March the property had an estimated fair value of 64 million. The directors consider that 25% of this fair value was attributed to the top first floor. So 25% of that one, which gives us 16 million. Which means this top floor has moved from 15 million to 1 million, which means we debit property investment by 1 million and credit income 1 million. So now So which means in the statement of financial position, the top floor building there, the value that we put under here, it will be 16 million. That one we are done. Let's go to land. Working number 2. Working 2. We say rand. So rand, under land here, let me just put very smart. Land, the initial cost is what? How much the initial cost? The initial cost of land is 25 million. Now, land is never depreciated. And in the question here, they are saying the directors are using what to measure? The directors also wish to use the cost model for measuring property, plant, and equipment, and the fair value model for measuring investment property. Meaning, land is being measured under property, plant, and equipment under the cost model. So land is never depreciated. Now, land and this case, land is not qualifying to be investment properties, of which you can say it is measured at fair value. No, so land is 25 million. It will still be carried at 25 million. Oh, sorry, on top, 25 million. Let's go to the building. And it will be carried at 25 million because land is not depreciated. Working number 3, which is what? Which is building. So building, the initial cost is 20 million. And then this land is also not qualifying to be investment property. It were accounting for under IAS 16 on cost model. So meaning this land need to be depreciated at the end of the year. Because we are accounting for it under cost model under IAS 16. So this land will be depreciated. It will be depreciated, meaning it will be 20 million 20 million divided by 50 years, because they are saying they are using what? Epsom depreciate a building component of property over an asset useful life for 50 years. So this one, and there's no residue value. So this one will be depreciated, and which will give us a depreciation of 400,000. So 400,000, it will be 0.4 since we are not adding the zeros. That is 400,000. That is depreciation. So under depreciation there, also debit building 0.4 million, and credit P and L 0.4 million. So when you come here, meaning land, what was the initial? Land, the initial was how much? So land, the initial was the initial from 20 million. It will be carried at, building will be carried at 20 million minus 0.4 million, which will be equal to 19.6 million. So then we even go now to our statement of financial position and put here 19.6 million. So let all these things be written smart. And we can add the total. is investment property. Total will be now income statement. Income statement will be what? Credit income. Income will be credited with what? 2 million. And then under expenditure, profit and loss with debited with 0. So we continue with our assignment. So that's how you tackle this question. Then you'll be home and dry when you reach this far. So this is how you tackle this question. First of all, you need to gather the information, and then you begin to deal with an item, separate an item according to how it is. I thank you so much.